It's a brave new world of investing, filled with NFT trading, cryptocurrency, and investor influencers.
My Rich Bff taught me.
Saving and growing your money looks different than it did just 5 years ago. A new generation of investors is changing how Americans make money. But these developments are also raising a lot of questions and a few concerns. Hi, I'm Ralphie Aversa from USA Today, and this is Your Money, How the Next Generation Invests. We're going to walk you through the new landscape of investing and look at all of those issues, but we're starting with the biggest new buzzword in finance right now, cryptocurrency. Celebrities, the uber rich, and everyday folks are putting their money in crypto. Here's a primer on it.
Cryptocurrency is one of the hottest trends in investing right now. If you want to get in on it, here's what you need to know. A cryptocurrency is a digital coin that lives on a blockchain, which is a decentralized computer network that records all transactions. Crypto doesn't depend on a central authority, like traditional currencies depend on banks, so its value is determined by how many people buy it.
The cryptocurrency market is extremely volatile compared to the broader stock market. So if you're someone who is concerned about taking on too much risk and can't stomach a lot of losses, it might not be the best option for you.
As of March 2021, there are over 9,000 cryptocurrencies on the market. Here's a rundown of some of the most popular coins. Bitcoin was the first to the game, and it's still the top player. Because it has a limited supply, some view it as a good store of value and a hedge against inflation, like gold. Litecoin is a cheaper alternative to Bitcoin and has been known to follow Bitcoin's trajectory. Dogecoin, which was created as a joke, became one of the top coins on the market in 2021. Ether is different from other cryptos because it's more than just a currency. Ether is the coin that powers the blockchain known as Ethereum, which allows users to build and run applications on it, kind of like how software runs on a computer. The price of cryptocurrencies can range from less than a cent to over $60,000, but you don't need to be a millionaire to get in on the hype. You can invest a fraction of the total price and you'll just own a fraction of the coin. But how much money you make will depend on which coin you buy.
If you look at Dogecoin, it's valued less than $1 right now. If you look at Bitcoin, it's at one point, it hit a high of over 64,000. It doesn't necessarily mean that some of these smaller cryptos couldn't take off over time, but it will take a significant amount of time potentially for these to try to get to the place and to be a broader payment tool than some of these bigger cryptos, say like Bitcoin.
And joining us now is our in-house cryptocurrency expert, Jessica Menton. Jessica, appreciate the time. All right, how does this work? Like if I wanted to buy crypto, like is this something, do I download an app, go to a website? Do I call up my financial advisor? How does this work?
Right. And everyone wants to know about this just because of the massive crypto FOMO that's been going on during the pandemic and especially this year. So it's interesting because crypto investing is actually virtually nowhere to be found when you're looking at 401k plans. And that largely has to do with the fact that there's a lot of regulations that still need to be put in place before wealth managers can try to advise that for certain clients that they have. But when it comes to trying to just buy it on your own, there are some cryptocurrencies like Bitcoin, which is the world's most popular cryptocurrency that is available to purchase for US dollars, and others that require Bitcoins and other cryptocurrencies like that. But to really buy a cryptocurrency, you need to get a wallet on an online app that you can hold the currency through. And generally, you can create an account through an online exchange, and then you can transfer real money to buy cryptocurrencies for, say, Ethereum. And Ethereum is the second most popular by market cap behind Bitcoin. But then Coinbase, for instance, is another popular cryptocurrency trading exchange where you can basically create both a wallet and buy and sell, say, Bitcoin and other cryptocurrencies. And also a growing number of online brokerages also do offer cryptocurrencies such as Robinhood. So a lot of people who say during the meme stop frenzy that was going on earlier this year, they also have access through Robinhood and some other online brokerages to also buy cryptos.
Okay, so I use one of those methods and I end up getting into this market. Take us into the crypto market here, Jessica. How is this different than buying and trading and owning a traditional stock?
It is very different because when it comes to buying stocks, for instance, you can even do that through your 401k plan, through dollar cost averaging. And there's this sort of old saying like buy and hold, where people will buy stock and hold it for a long period of time. When you're thinking about a number of decades, say saving for retirement, when it comes to cryptocurrencies, even say Bitcoin, that's the one, the biggest crypto and the one that's been around the longest, that's only been around for a little over a decade. So when you're looking at that asset class with cryptocurrencies versus the broader stock market, there's not as long of a history to go back, and they're quite volatile because they do trade 24 hours a day. Whereas when you are looking at the broader stock market that's trading from, say, when the stock market opens at 9:30 a.m. Eastern in New York and then closes at 4 p.m. And then obviously there's after hours and pre-trading, but it is very different to try to buy a particular type of stock versus buying a particular type of cryptocurrency. But wealth advisors are starting to take these alternative investments more seriously, and their clients are asking them how they can incorporate cryptocurrencies into their portfolios to generate more money for their nest eggs. And so when it comes to buying stocks, it's a lot easier to say go to a wealth manager if they're managing your different brokerage accounts and retirement accounts to try to get that in, versus because of the lack of regulations with cryptos that have been going on for a while now and people are waiting for that, it's a bit harder for some investment professionals to try to advise their clients. Some of them that I've spoken with more are keen to try to do that soon because so many of their clients are interested in having access to this and having exposure to this, because different researchers that I've spoken with think that as far as with the technology and society, it'll take at least a decade or longer for society to catch up with what crypto is doing. But they do have a view as far as how this could be favorable to different retirement accounts, but it's going to take a lot of time.
You mentioned crypto is more volatile than the traditional stock market. What are the factors impacting the prices in crypto? Are they the same as the traditional stock market when we talk about things like the economy and GDP and so on and so forth? Or are there a new set of factors here?
That's a great question. Some people view Bitcoin as a store of value and a hedge against inflation, say, and traditionally people viewed that when you're looking at, say, gold. But there are people who have different arguments against that. But it is interesting when you're looking at the economy. Some people have looked at Bitcoin as an alternative to that, as we have seen inflation begin to pick up, obviously, this year during the pandemic for all sorts of various factors. The SEC, for instance, in recent years has issued several warnings for investors to be careful and to watch out for any sort of fraudulent digital asset and crypto trading websites that could be trying to defraud different investors. So you do have to be careful when you are looking at some alternative investments that are out there.
Up next, from Wall Street to TikTok, Cody Godwin speaks with an investor influencer who's making financial advice more accessible to the next generation.
Social media influencers aren't just promoting clothes and beauty products anymore. They're also giving financial advice to a young generation of investors. I'm joined by Vivian Tu, an influencing investor known as your Rich Bff. Thank you for joining us, Vivian.
Thank you so much for having me.
What's the origin story for your Rich Bff?
So I started my career on Wall Street. I did my time as an energy trader in the equity space. And when I left Wall Street, I joined a tech company, and I had a lot of colleagues and friends say things like, hey, you're coming from Wall Street. Can you help me figure out what I should be putting into my 401k? Which, health insurance plan did you get? How are you investing? And it got to the point where so many people had asked the same question, it started to become a running gag. I'd be like, oh, refer to my finance TikTok. And, I actually started one, and it ended up being a big hit.
I, your new Rich BFF, I'm going to teach you ways on how to grow your wealth with my best financial literacy tips and tricks. When's the best time to ask for a pay raise? Right now. Hey, how much should I contribute to my 401k? I don't know your financial situation. Okay, yes, but what are you supposed to put in? I'm thinking about paying off my student loans or credit cards and starting to invest. I'm just not really sure which one to do first. Oh, you should just follow the 7% rule.
How is finance and investing different for the younger generation than it has been for previous generations?
There is a new level of keeping up with the Joneses that there has never been before because all of us have social media. So people are making financial decisions that in other generations may not have been wise or something that was prioritized. Additionally, I would say our generation has more student debt, is coming into a very, unstable economic and global situation, more so than any of our past ancestors. So we have to think very strategically about how we want to be spending and saving and investing our money.
What kind of financial advice has resonated the most with young investors?
I think the fact that my financial literacy tips that I provide on my channel are only 60 seconds or less has been really nice for my audience, because they're looking for easy, digestible content versus having to read an entire book or watch an entire hour-long TV special.
But I saw this guy on TikTok. Let me guess. He promised that by investing in life insurance, you'd be able to make 4 times the amount of investment income in retirement versus using a traditional retirement account. Yes, and then it wouldn't matter if the stock market went up or down, right?
Why do you think the younger generation is turning more towards social media for finance tips than the traditional sources?
Because they're turning to social media for everything. In the same way that we are now looking to social media for what products to buy, what gifts to give our relatives for the holidays, we're also looking to social media for other aspects of our life, and financial literacy, I think, is included in that.
Finance is a pretty male dominated field. So, what's it like being a female investing in influencer? And does that affect the information that you're giving your followers?
Yeah, I think it's so important that I am a woman and a woman of color, sharing this information, because it's a lot more relatable. Financial literacy and financial advice historically has been incredibly male dominated, incredibly white, and having people see that, oh, someone who may look like me is able to do this gives them a little bit more inspiration to try it themselves. In addition to that, I think it's important to call out that investing for certain sets of the population does look different. Women live longer. We receive fewer pay raises throughout our lifetimes. So it's really important to create niche content that applies to a bunch of different audiences.
Then think about how much you want to ask for, depending on how recently you got a raise, your performance, and what you bring to the table.
Is there a downside to getting financial advice on social media? What should young investors be watching for when looking for investing advice on TikTok?
I think there's a lot of folks who are talking about finance and financial literacy without actually having the credentials or having the background or even doing the proper research to do it. I've definitely seen some sketchy stuff floating around the internet. And what I recommend for everybody is anything that you see, just do a quick Google search and see if you are able to essentially corroborate that, and make sure that you're getting a bunch of different reputable sources saying the same thing before jumping into something and assuming that it is true.
What is the biggest piece of advice you'd give to Gen Z when it comes to financial literacy?
Number one tip, talk to each other about money. In the generations before ours, talking about your salary or how much you were spending on rent was super, super taboo. Whereas this generation forward are now more open with each other than previous generations ever have been. That's going to be a benefit, because you're going to be able to share how you're budgeting. You're going to share how you're able to negotiate your salary up. You're going to be able to share what you're investing in. And those conversations are only going to drive all of us forward. Rising tide, lift all ships. So I think having these conversations are going to be super, super important.
Up next, Ralphie Aversa walks us through NFT trading and everything you need to know about it.
NFTs are those cool little graphics or memes. Sometimes they make you smile, sometimes they make you laugh, other times maybe they got you thinking a little deeper. NFT stands for non-fungible token, meaning it can't be replaced. It's totally unique and it exists only online. Think of it like a baseball card with Joe DiMaggio's signature on it. It's totally unique and can't be replaced by anything else. There's now a pop-up community of people trading NFTs, and sometimes for big bucks. For example, one person paid $389,000 for a 50-second video by the singer Grimes. One of the most expensive ever sold was by digital artist Mike Beeple Winkleman for $69 million at Christie's auction house. Fans say this is the future of fine art collecting, but here's the rub. If you buy an NFT, you get ownership of the work, but the original artist keeps copyright and reproduction rights, meaning they could decide to sell more NFTs of the same piece of art. You have basic usage rights, like being able to post it online, and you can sell it if the value goes up. But it still lives forever on the internet because, as we all know, stuff posted never really goes away. So that's leading people to scratch their heads and wonder, will NFT trading really last? Coming up, when the stock market meets Nintendo, some new apps and platforms are making trading seem like gaming. Terry Badu has that next.
I was right. It is so comfortable. I feel like I can sit there.
That's an old ad from Robin Hood showing how it would drop confetti virtually on first-time traders. It's a typical action reward system. Make a trade, get a reward. Invite a friend to join, get another reward. It's part of the gamification of stock trading, and it's being met with concern from some people in the industry. And joining me now is Michael Surrey from the University of Texas, Austin. Michael, can you first explain the concept of gamification?
So gamification is essentially the creation of an entertainment platform for trading stocks. And what we've seen over the last several years is as apps have started to develop, they've catered to a younger audience, and they've incentivized this younger audience to start trading more via their platforms by making it more of an entertainment experience. And in so doing, what I feel has happened is they have essentially made it more of an entertainment rather than an investment experience. And this is something that has caused a lot of problems lately.
So, Michael, what's the reason that gamification came about?
So brokerage firms for a very long time, historically, their business model has been based on incentivizing investors to trade more often. The more trading that an investor does, the more commissions are generated for the brokerage firm. So lately, with the development of technology and apps, there has been the ability to create an entertainment-like experience that essentially gets investors involved in essentially speculating or gambling on trading rather than making a long-term investment decision. And so this has actually happened for a very long time in lots of different formats. We used to see commercials for old line brokerage firms that used to show people making lots of money and being very excited about trading. Well, now that has moved on to the web and has moved on to online platforms. And what we're seeing now is that these digital apps are showing, as you mentioned, confetti dropping and showing that, hey, you're a winner if you make a trade. It's focusing investors on being very narrowly focused on the short term rather than long-term investment objectives.
Robinhood changed the game for everyone. The design was just intuitive and simple to invest, simple to track your portfolio.
Now, we mentioned Robin Hood, but it's not the only social media app doing it, Reddit being one of them. How widespread is this?
It's become fairly widespread. Of course, Robinhood is the poster child for a lot of this activity, but as you correctly mentioned, the Reddit boards, especially Wall Street Bets, has been very active in having conversations and essentially a small team type forum for encouraging other investors to get involved in trading, to get involved in hot stocks, to follow the news and the tips wherever they may go. And what we found is that this democratization, which may be a good goal in and of itself, but it does come with some of these dangers that people are getting invested in names and stocks that they may not necessarily understand. They haven't necessarily done their homework. They're simply following the crowd. And that can have disastrous consequences when uninformed investors are making investment decisions that could impact their long-term objectives.
But isn't trading always a gamble? What's wrong with this new form?
I think the difference here is confusing trading or long-term investing with speculation and gambling. And I think the difference is in what your objectives are. Are you investing in order to meet retirement objectives, to meet income requirements, to satisfy certain obligations that you may have? Or is it being done purely for an entertainment experience? When you put those two together and commingle them, that's where the problems occur.
Can you see it coexisting with traditional forms of stock trading, etc.?
I think it's very difficult. I mean, one of the things that needs to happen is that investors need to educate themselves on the differences between investments, speculation, gambling, trading. These are all different types of ways to participate in the markets. And essentially, they satisfy different objectives. And so investors need to clearly understand what it is they're trying to accomplish. Are they trying to accomplish having a good time, getting entertained? Are they really viewing this as gambling money? If so, they need to think about how much can they really afford to lose. On the other hand, if they're really doing it to build a long-term portfolio, to build up their nest egg, then that's a different set of objectives that requires a more careful and rational process.
Hey, thanks for watching. If you like this video, check out these other videos from USA Today to stay up to date with all the latest news.